Hello, in this lesson we are going to look at the 2007 and 2008 financial crisis. So, the 2007-2008 financial crisis, I'm sure many of you have heard of it. Some of you may be aware of the ins and outs, but I find a lot of people don't truly grasp what exactly happened and why it happened. So, they there was it's essentially a combination of two things. So it's a combination of two things, and these two things are debt and mortgage backed assets. Both of these go hand in hand, and something that you have to know is that since World War II, so since World War I'll just put 2 here. World War II, house prices, so let me just draw a quick house. This is going to be the most amazing house that you've ever seen drawn in a video. Draw some windows. I remember this is the way I used to draw it at school. I was just as bad then as drawing as I am now. And the house price, it's actually an up arrow, so which is convenient, but house prices had been going up. These are arrows just pointing up. House prices have been going up since World War II in the USA and in many countries as well. Overall, the financial crisis was around the world. It ultimately started and was led by what happened in the United States, and because the USA is so powerful in terms of its economic might, whatever happens to it, good or bad, especially the bad side, has a trickle down sort of domino effect on all the other countries, especially its allies or countries that is closely linked with. So since World War II, the prices had been increasing, which obviously people love. But before we start talking about the houses in terms of people buying them, in the 1980s, actually this is something that people don't quite realize, is that the financial crisis, or any sort of financial crisis really, but especially the 2007-2008, essentially spanned many decades. The effects that ultimately led to it spanned many decades. So it's not something that happened like 2 years prior to that period, like in 2005, 2006. It had been going on for a long time, and it ultimately just collapsed the system. So in the 1980s, financial institutions and traders realized that US mortgages were an untapped asset that they could make money off. And if they can make money off it, trust me, they're going to make not muffins out of it. They might buy muffin using the money, but they're going to make money out of it. And traders, this is where it started. So obviously all the banks started doing it. Traders at Salomon Brothers and Drexel Burnham Lambert. Traders at Solomon Brothers and Drexel Burnham Lambert basically they were looking to expand the bond market, because obviously if they can expand it, they can generate more money, which is obviously in their eyes very, very good. So they were looking to expand the bond market, and what they wanted to do was essentially use this asset that nobody had thus far utilized, and by utilizing the asset they would be able to make more money. And obviously by utilizing this asset they needed to sort of restructure it essentially, because the way it was at the moment, people weren't going to just easily make money off it. So what happened was they noticed, let me just get rid of that. They noticed that a steady stream of mortgage payments were coming in, obviously by people. Mortgage payments, because obviously people want to live in their houses, so they essentially are paying money every single month to be able to live in those houses because they have mortgages. And what some clever bankers did, because no matter if you hate them or like them, whether they did good or bad, overall they did bad in my opinion, but regardless of that, they are still smart for doing this, just in terms of like what they was trying to achieve. And they realized that they could be restructured, so these mortgages could be restructured, let me spell it correctly, restructured into bonds. And then these were sold, they were sold to investors such as big financial institutions. They bought these essentially mortgages that were repackaged into bonds, and they were backed by these subprime mortgages, which essentially they were going to get money from after those people had paid up. So they were getting interest from that, as bonds usually work. And one of the reasons people liked these mortgages or these bonds, because prior to this, investors could only access the mortgage market by either buying real estate, which is obviously a whole industry in itself, and that's a lot of work, or investing in construction companies, which again, not every investor wants to do. So they were essentially cutting out, in a way, the middleman and just going directly to people that were already inside and were already going to be inside of the housing, sort of the mortgage market, and they were essentially buying the bonds that were just mortgages essentially. And okay, this was going on for a couple of decades, and what happened was the government lowered the federal funds rate. And if you don't know what the federal funds rate is, it's essentially the rate that the government ideally wants banks to lend money overnight to each other. So banks do lend money to each other, and there's a rate that they ideally want the interest to be at, because the bank's not going to lend it to another bank for free. They want some interest. The government wants a particular rate, and they don't specifically say this is the rate. It's not like written in law or anything. The rate is just changed by the government either printing more money or buying back securities, and using these techniques they can increase or lower the interest, essentially the federal funds rate over time. So it was lowered from 6.5% in 2000, 6.5% in 2000 to 1.75% in 2001. So this is May of 2000, this is December of 2000. So as you can see, within a year and a half, the federal funds rate was almost cut by 75%, which is a major reduction. And it hit essentially its lowest in June 2003 and it hit 1%. So this is a huge decrease, and this was the lowest in 45 years. So lowest in 45 years, the lowest in 45 years. And all of this essentially meant, because banks were able to get money easier, low interest loans, and the loan that we're concerned with is a mortgage, because some people will say it's not a loan, a mortgage is, and it's like they just rebranded it to make you think it's not a loan, but it is a loan. It's just a long-term loan. So low interest loans were easily accessible for the average person like you and I. So, and when I say easily accessible, I mean people with low income, even sometimes people with no income, which is obviously just ridiculous, with low number of, I'm going to put a hash for a number, low number of assets, whether that's a previous property or a business or a car. They had low number of assets. Sometimes people had no jobs at all, which obviously if you're lending something to somebody and you expect them to pay you back in some way with interest, if they don't have income, they don't have assets essentially to sort of protect it with, and they don't have any jobs to be able to get this income, then obviously we look at it now and think that's just ridiculous. Why would you lend something to somebody if you're going to want it back and with interest, if those people clearly just based on their sort of situation won't physically be able to pay you? But obviously in the short term they was able to just repackage these mortgages and they were just selling them off. So in the bank's eyes they were thinking, well, yes, we're not necessarily going to immediately get the money from these people, but we're selling them off as bonds. So essentially they're not our concern anymore. And the rising, as we mentioned, the rising house prices, basically made getting a mortgage a good investment, because what they could do, get a mortgage, and if they could sort of pay it, the price of the house would just keep increasing. At least that was the plan for a lot of people, and then they would just sell it. Even if they didn't sell it after the house was fully paid off, they could literally sell it during the mortgage and still make money, which for a lot of people was a very attractive prospect. I knew people that wanted to do stuff like that. Well, I'm sure everyone did. I still know people that still think that essentially because of the way house prices have been over the last few decades been going up, apart from the obvious financial crises, that it's always going to be a good investment. And I've heard them say stuff like, I've had my siblings say this, that it's a rock solid investment and house prices will always go up. And it's just like, if you look at basic economics, that can't happen. It can't just keep going up unless inflation just keeps going up. And then essentially you're not making money, you're just sort of just keeping in line with the inflation rate. So ignoring that, so what started happening afterwards, a few years later, nearer the 2007 and 2008 period, the interest rate, rates started increasing. And the way they started increasing was through ARM. And this is actually a certain type of mortgage. It stands for adjustable rate mortgage. So people was getting these ARM mortgages. These were the mortgages that were lent to subprime the lenders, the subprime borrowers, the one that had low income, the one that essentially had a low credit score. So what they was doing, like on a 30-year mortgage, first 5 years might be low interest rate, and then after 5 years it suddenly increases and they can't physically pay it. So what happened was the borrowers could not pay it after a few years. So the mortgage holders, the mortgage the mortgage holders were unable to pay, which meant they defaulted on their loan. So they defaulted, and I'm sure you've seen pictures, you may have even seen it in person, that homes were getting confiscated and a lot of people was basically left in a really, really bad way. And buyers of these subprime mortgage-backed bonds, so buyers of these bonds that were nothing but subprime mortgages repackages, started filing for bankruptcy because ultimately they had bought these bonds that were backed by subprime mortgages. The individuals that were getting the houses couldn't pay for them, so these banks and financial institutions that actually held over 1 trillion, yes, $1 trillion alone of these subprime mortgages that were repackaged into bonds, they started filing for bankruptcy. They went bankrupt. And many of them actually went bankrupt. They actually filed for, I think, is it Chapter 7 bankruptcy? Because there's Chapter 7 and Chapter 11. Chapter 11, I believe, is essentially the one that companies use to restructure their assets. The business overall is a good idea, but they just need to restructure. And Chapter 7 is the one, I might have got them mixed up if I have, sorry, but Chapter 7 I believe is the one where the actual running of the business does not make sense and they're not making money, so they essentially do shut down. So they filed for bankruptcy and they didn't get any of the money back. The government did step in. They tried to decrease the federal funds rate again, the discount rate, which is essentially the rate at which these financial institutions can lend from the actual government itself, from the Federal Reserve. That didn't happen. The snowball had already started rolling down the hill and it just got bigger and bigger, collapsed the United States financial market, not just the housing market, but just the financial market in general. It really had a big part in crashing that, and that ultimately led to the crash of a bunch of other markets around the world and many other countries, and just United States in general hasn't been able to recover fully since. So this has just been a pretty long video on the 2007-2008 financial crisis. There is a lot to cover about this, so I've just tried to do the best I can in the time that I've got. If you've got any questions, if you're unsure about anything, or you would like more information, feel free to reach out. I'll help you as usual, and I look forward to seeing you in my next lesson.